watching Market Week in Review, the week ending January 30th, 2015. I'm Blair Lowman, and I'm coming to you today from Russell's global headquarters based here in Seattle, Washington, and I'm joined by Chief Investment Strategist Erik Ristuben. Hello, Erik.
Morning, Blair.
So we saw the positive GDP number come out this morning. Not quite as positive as we expected, but still positive. And there's also been quite a bit of speculation surrounding the recent Fed statement on Wednesday about the possibility of future interest rate hikes. What key takeaways should investors take away from the U.S. markets this week?
Well, yeah, as you indicated, the GDP number, the headline number of 2.6, that's almost half of what we saw in third quarter at 5%. So the good news was they reaffirmed the 5% growth rate for third quarter. So third quarter was, as we suspected and felt, was a very good economic quarter. Fourth quarter number, you dive into some of the below the headlines. 2.6 was the total number. The private economy grew at 3.7%. So what's the difference? Government. And government spending was off in the fourth quarter, and particularly in defense. So I think when you look at it, some of the things you would expect, exports a little bit down. I mean, the dollar is stronger than it was. Our exports are stronger than they were. We were expecting a number well below 5. 2.6 is lower than we were expecting. We were looking in this, 3 to 3.5 range. But we still think there's enough data in that report to show that the U.S. economy, by and large, is weathering a strong dollar and some of the weakness outside the United States. In fact, when you look at what the Fed said, back to the Fed statement, they actually replaced moderate growth, which is what they've been using to describe the economy up until these minutes. They actually replaced that term with solid growth. And in the kind of Fed Kremlin watching, the sport that is our business, that's a meaningful language change, because that means the Federal Reserve seems to be getting more confident. Maybe not in the magnitude of U.S. growth, but the stability and maintainability of U.S. growth. And we think that they're continuing with all the improvements we've seen in labor. We think they're continuing to kind of aim at a June, mid-year kind of interest rate raising program. So we still think that's on target.
So now that we better understand the volatility that drove the U.S. markets this week, let's shift our focus over to Asia, especially Japan and the Nikkei index this week, which experienced its largest one-day drop on Thursday in the past 2 weeks. Is this volatility something that investors should expect going forward?
Well, yeah, we've had volatility here in the U.S., we've had volatility in Europe, we've had volatility in Asia. So I think it's probably a pretty good idea if investors are expecting volatility in all equity markets. Equities are volatile. But in particular, Japan has been dealing and struggling with the impact of the consumption tax that went into effect last year. And one of the reasons you saw such a precipitous drop on Thursday was that actually you saw a bad household consumption number. So household spending was down about 3.2%, and households are consumers. And so, if the consumption tax is continuing to present a very strong headwind to the Japanese economy, some investors are concerned that may actually be enough to swamp the progress that Japan has had. But we think Japan is actually going to navigate the year actually fairly well, and as a result, we think stocks in Japan will do reasonably well.
Okay, that's interesting. And usually on this segment, you discuss not only the economic impacts on the markets, but the political impacts as well. And there's been no shortage of political turmoil in Greece this week.
Yeah.
What can we expect going forward? Is this something that investors should keep their eye on, or is this more of a non-issue for investors?
A non-issue, that's too de minimis. But is it a big issue? No, we really don't think so. What we have is a new party. Syriza has now taken the control of the government. Now they won the largest voting bloc. They did not win a majority. They had to form a coalition government. Some of the things that they've said so far this week give you an indication that we're going to see more volatility, right? They talked about the ending some privatization, particularly some ports and things, and they talked about the raising the minimum wage. There's also some discussion and some conjecture around their willingness to live up to the debt obligations of the triad that came in and gave them the bailout money. All of things lead to concern over Greece, and it gives us another reminder of this link that has existed in Europe and needs to be broken eventually between the banks and sovereign government. So you got this turmoil and this change going on in the sovereign government, and bank stocks on the Athens exchange are now 41%. That is directly related because anytime there's any conjecture about what's going to happen potentially to Greek debt, Greek banks own a lot of Greek debt, and so they get hammered. But when you look at other countries like Spain and Italy, right, the contagion effect potentially of Greece, doesn't look like the market's all that concerned about it. Both of their 10-year debts, both Spain and Italy's 10-year debt, is yielding less than a 10-year Treasury, U.S. Treasury right now.
Well, it's important to make that connection, and thank you so much for your insights, Erik.
Thank you.
And thank you, and we'll see you next week.